all, I think it's very prudent, and I think it's absolutely right for the IMF to go ahead and do this warning. We clearly have seen over the course of the last couple of weeks that the impact from a world where we have three drivers of the tighter monetary condition, one being the price of energy, of course, with this byproduct of inflation risk. But we also see the price of money through the Fed mainly, and then the quantity of money globally is collapsing. So in other words, the credit cake is lower. So I think absolutely prudent on IMF to do this.
Is the IMF right, though, when it's saying that many market participants appear complacent about the risk of a sharp tightening in financial conditions? Because if you look at the reaction we've seen on yields lately, there's been a very strong move higher and a short, sort of swift move along the curve in the States from the 2s, the 5s, the 10s to the 30. Is it fair to say that investors are just sitting there complacent, waiting for a storm to hit?
You know, it's very rare that I sway with any policy institute globally, but I absolutely think they're right. And I think what they're really pointing to, especially in the stability report they just came out with, is the fact that the U.S. market is on its own. And the reason the U.S. market is on its own is exactly Mr. Trump, as we heard from before, because the tax plan in the U.S. has meant a massive amount of repatriation into the U.S. economy. The buyback program in the U.S. this year is $1 trillion. And that is basically $1 trillion used to reduce the amount of floating stocks in the world. Why is that relevant? It's relevant because, of course, it makes the volatility artificially low in the U.S. stock market. It's almost going alone. So I think what IMF is really doing is just pointing out that if you exclude the U.S., the world is already moving to the brink. Whether we go beyond the brink, I think it's more an issue of how fast the Fed and how insistent the Fed is on keep having this trajectory of higher rates. I think, for my part, that the Federal Reserve is doing a mistake by ignoring this massive inflow on the back of the tax plan in the U.S., and doing so, they do a policy mistake.
Sir, you say that, and you say that the world is moving closer to the brink, but actually their forecasts for growth are still at 3.7%. These are still very high levels if you put it in the context of how growth has been in the last 10 years or so. And actually, they haven't revised down China forecast for 2019. There has been a moderate revision lower for U.S. growth, but to me, it seems as though the outlook for the global economy still seems pretty robust. We're still north of 3.5% here.
I have to smile at that because, of course, the wording from the IMF is significantly stronger and more harsh than the actual report. You have to remember these reports is a reverse engineering process of getting a very marginal change to the outlook. They don't want to scare the market by printing numbers that are worse. But I think you really see their concern in the trade issues. In the trade issue, they are pointing out that the true cost to this trade tension could be a full percentage points off in the U.S. growth and 0.5% off in the global growth. I think they're really telling us between the lines, this is what is happening. Yes, we have a slight reduction of 0.2 for global growth from 3.9 to 3.7, but the true risk is that we will be back at 3% global growth, and 3% global growth is very similar to a recession-like environment.
What are you advising clients to do here then, if that is your view and you think that the risks are much higher than those that are being flagged, at least numerically, by the IMF? What do you do then?
Yeah, so there is a valuation metric in play here, and that being that the US is more than 3 standard deviation expensive relative to MSCI World and certainly to emerging markets. So what we are saying at a bare minimum, do acknowledge the fact that the US is expensive by reducing the US, and if you don't want to reduce overall equity exposure, go to the MSCI World, or go even take a little bit of risk in emerging market from here, despite all the turmoil I just described. But also, I think for our investors, we are asking them to wait and see, because this policy mistake by Fed is typically faded by the market as we come into the later part of this year. So I do expect the Federal Reserve, and I do expect the next monetary policy response to be somewhat more of a QE Japan-like open-ended happening in the course of the early parts of next year. But for now, we're pretty much just saying to customers, be aware that the market is underestimating risk, certainly in the cross-allocation models.
Steen, I want to ask you directly about China, because as some market commentators say, keep a watch of emerging markets, there are still opportunities. China keeps jumping up as one of the #1 plays for many investors, despite the fact it's right at the epicenter of all of these trade disputes. Many are looking at the measures from the Chinese authorities. We've had a couple already this week. The moves on the RRR to inject more liquidity into the banking system, moves to devalue the currency. Can China provide some form of a safe haven despite the fact that it's right in the mix when it comes to the trade dispute with the United States?
In the case of China, I think they were hoping for a bigger response from the RRR. They will argue that the RRR is really done to take the shadow economy onto the balance sheet of the state-owned enterprise banks. That, of course, is a very slow process, similar to if your factory changing from doing golf cars to doing Audis. So it will take time. But I think in the case of China, they are clearly concerned, and more concerned than they actually is letting us know. And we do also know that when that happens in China, the response function is always, and I mean always, more intervention and support for the marketplace. So I think if we are not able to take out the recent lows in the CSI 300 and the Shanghai, I think there could be a buying opportunity. But I think you're very right to point out you have to be cautious, you have to give it time. And if you are buying the emerging market, you probably should average in over the next 6 months. But there's absolutely fundamental value. We don't think China is a value trap, but we do realize that there are significant risks in the case that China doesn't get the full transmission mechanism that they're hoping for.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.